Hello everyone and welcome back to another video. So recently, software stocks have been getting absolutely decimated in the stock market, with many of the most popular software stocks being down double digits just over the past month alone. This is because there has been continued advancements with artificial intelligence and specifically being able to develop and write code, which a lot of investors are worried is going to make software as a whole commoditized, irrelevant, and compress the profit margins across the entire industry. I personally own a handful of software stocks, including Constellation Software, that have been included in this overall software stock sell-off. Now, what I've been noticing, though, is that the selling seems to be indiscriminate, which means people are selling software stocks of every single kind, and not really thinking about which ones may actually benefit from artificial intelligence and which ones will be disrupted. And when this kind of indiscriminate selling happens across an entire industry, I think it presents an opportunity to buy the highest quality stocks within that industry at a discount. So what I have been doing over the past week or so is researching a lot of the most popular software stocks that have been hit in this overall sell-off and ranking them based on their AI disruptability risk. And in today's video, I want to go through all of these companies and all of their stocks and my own personal weighting on if they actually do run a real risk of being disrupted by artificial intelligence or not. I also created some other charts by gathering data across the industry to help identify which stocks may be looking undervalued today and which ones may still be looking quite expensive. So this is going to be a very in-depth video, basically analyzing the entire software sector and trying to identify stocks that could be looking compelling today. But before we get into my AI disruptability ranking chart and the other charts that I have made, we first need to discuss the different kinds of software companies, which are vertical software, horizontal software, and generative software. In the software world, a horizontal company is one that provides a general purpose solution that can be used by almost any business in any industry. Whether you are a local bakery, a global bank, or a construction firm, you likely need a way to track your customers, which is what Salesforce does, manage your tasks, which is what Monday.com does, or coordinate your projects, which is what Atlassian does. Now, because these softwares are more horizontal and they cover many different companies, they have to be more generalists in the software industry. And if you're a software generalist, then you're probably just surfacing the customer's data and creating dashboards or workflows on top of all of it. Or in other words, you're not really going that deep within the company's operations and getting that deep into their data as a whole. Or in other words, you're probably just creating UIs and workflows at the surface level of your customer's data. This type of software typically isn't very unique, and it's something that artificial intelligence can easily replicate. So now let's talk about vertical software. Vertical software is built for a specific niche, and would be useless to anyone outside of that niche. An example would be a software for tracking water meter usage and sending bills to residents that live in small towns. In general, vertical software tends to be more sticky and immune to AI disruption because it is deeply embedded within a customer's operations. Horizontal software is more general purpose and sits on top of surface level data with dashboards that again can be easily replicated with artificial intelligence. Switching costs of vertical software are much higher, more sticky, and cumbersome, since the business operations run on and through the software. I made this quick illustration on Canva to try and visualize how horizontal versus vertical software companies work. And every single one of these black lines represents a software company. Now, the depth of this line is where different software companies sit within the company's data. And this right here is how your typical horizontal software company sits within a customer's data. So you can see that their software is applied to many different companies, but they don't go that deep within the company's data. This means that they're not as sticky, or the company's operations don't truly rely that much on the software, and they could easily switch. Now, a vertical market software company doesn't apply to every single business, but it sits deep within the company's data. So a vertical market software company may apply to this business, or this business right here, or it could even be the foundation of what this business's operations rely on. So these vertical market software companies may not have as large of TAMs as the horizontal software companies, but they are much more sticky because the businesses rely on them much, much more. And this is why they are more immune to AI disruption and less likely to be replicated by competitors. Now, lastly, we need to talk about generative software. Generative software companies are those that use prompts to generate content, whether that be images, videos, websites, courses, etc. The danger for these companies isn't that they will fail to use AI, but that AI will make their core product free everywhere else. And this is something that I have been concerned about with a company like Adobe in specific, Because 5 years out into the future, I think artificial intelligence is only going to continue getting better and better at an exponential rate. So at some point, if you are able to AI prompt an entire video, like even a YouTube video, then that could allow people to completely bypass Adobe's products like Photoshop or Premiere Pro. Now, Adobe is not seeing any disruption in their financial metrics, as we're going to see a little bit later on in this video, and the business is continuing to grow pretty dang well. But over the long term, I do think that there is a real risk to every business that relies on content generation as a whole, whether that is actually generating the content or allowing people to make content, because artificial intelligence seems to be specifically good at content generation, and it's actually getting quite wild. So now let's get into my AI disruptability chart, which again covers all of the different software companies that I took a look at and how much I think that they could be impacted by artificial intelligence. So let's start off at the bottom of the chart with the companies that I think have extreme risk of AI disruptability. And the first one is Duolingo. Now, Duolingo is technically a vertical software company because they are solely focused on the education space, and they're not really horizontal, and you can't apply them to every single business out there. However, they are a generative software because they essentially provide different educational lessons and courses for people to learn a new language. And this is something that I think artificial intelligence is very good at and could easily replicate. In fact, Google is expanding into the AI education space, and I do think that they are starting to attack Duolingo's moat. And if we go and take a look at Duolingo quick, we can see that the stock is down 71.6% from its all-time highs. Now, I don't necessarily think that this is an accurate reflection that the business is actually going to be disrupted, because if we take a look at Duolingo's financials, we can see that its revenue growth is pretty fantastic, and even in the most recent quarter, it is hitting an all-time high for revenue. This is the same story with the company's cash flows and profits as well. So I don't think that Duolingo's current revenues and financials are showing that much disruption from artificial intelligence, but they're also projecting their business to decelerate by quite a bit over the coming quarters. And I think that this is why the stock is down so much and why investors are getting quite spooked. Duolingo has also said that they have more than doubled the amount of courses on their platform in just 1 year by using artificial intelligence. So they are clearly leveraging AI to increase the amount of content that they have and the amount of value that they have on their platform. However, this is kind of a double-edged, kind of ironic sword here, because if Duolingo has been able to double the amount of content on their platform in a year using AI, then it kind of suggests that AI can do what they're doing. And therefore, I do think the AI disruptability risk over the long term is pretty high for this business. Now, the pro about Duolingo is that they do have a massive distribution network. I strongly believe that all software company moats are not necessarily determined by if the business can be replicated one for one, because there's much more to a business than simply creating a software. You also have to go out there, you have to market it, and you have to, get that distribution out there, which Duolingo has done very well. So just because Duolingo may be able to be replicated one for one by artificial intelligence, that doesn't necessarily mean that the business is going to go to zero or start losing paying subscribers. Now, the next business that has an extreme AI disruptability risk is Wix. Wix is a horizontal software company that allows pretty much anyone or any business to build a website and host your domain. However, I think that artificial intelligence is getting very good at generating websites because there's not that much unique data that goes into surfacing a website. You're pretty much just making a landing page for your business, and you can give AI a very brief description of your company, what it does, give it some assets, and it can spit out a website for you. Again, AI is getting very good at doing this, so I think that website creation is going to become a commodity, and that's the vast majority of Wix's business today. Wix did buy an AI no-code platform called Base 44 that saw a massive explosion online. It was all the hype for a little bit, but the customer reviews on Base 44 have been pretty dang bad. So this vibe coding tool that allows you to build apps and websites and potentially even video games seems like it is very buggy and not quite there yet. So I am not necessarily convinced that this is going to be a long-term driver for Wix's business. And so far, it seems like it kind of has been a flop acquisition, but we're going to have to see how it plays out over the long term. But to put it simply, I think that Wix has a very high chance of being disrupted by artificial intelligence because it's clearly replicating what the business already does. The last business that I have at extreme risk of AI disruption is DocuSign. Now, personally, I am surprised that DocuSign's business is even still around because back during COVID especially and right before COVID happened, This business was popular because it was like the industry standard for allowing you to sign contracts online. In fact, the house that I purchased in 2019, where I record all my videos and, well, where I live, I signed that contract with DocuSign. However, over the past few years, it's become such a commodity to be able to sign documents online, especially as our world has moved over to the internet. You can sign documents now with Google and Adobe, and it's just really not that hard. So I think that DocuSign's business is very at risk of being replicated by AI. I think that it already kind of has been, and I think this business has no real moat. It is the exact type of business that I would avoid like the plague. So now let's move up the AI disruptability risk from extreme to high. And the first business right here is Adobe. Now, as I shared earlier on in the video, I think that pretty much any company that is in the generative space is at a higher risk naturally, because artificial intelligence seems to be very good at generating content, whether that's text, video, or images. Now, Adobe is fighting this off by allowing you to generate images within Photoshop, and they're starting to also allow you to generate video within Adobe Premiere Pro. But as I said earlier on, if AI truly gets to the point where you could prompt an entire video and it's edited well, or you could edit it just with prompts and, the AI figures out how to do that extremely good, then you could bypass the need to use Photoshop or Premiere Pro as a whole. And I've said this before, but as a YouTuber, this kind of worries me and sucks a little bit because I see a world where social media and even YouTube is flooded with digitally created or artificially created content. And that's going to really water down content creation as a whole. Now, I use Adobe Premiere Pro to edit all of my videos. That's what I'm editing this video on right now. And I also use Photoshop to make all of my thumbnails, but I probably could use a competitor like Canva. But overall, I do think that Adobe is a business where it is really at risk long term of AI disruption. And if we go take a quick look at Adobe stock, it is currently down 52% from its recent highs that it set in February of 2024. The business is also selling for only 12.6 times free cash flow now, which is an 8% going in free cash flow yield. I believe that this is one of the cheapest the stocks has ever been. Now, if we go and take a look at their fundamentals here, we can see that Adobe's revenue growth is very, very consistent and it's continuing to hit fresh all-time highs. They're also projecting around 10% annual revenue growth going forward. So it seems like so far, at least, the business has not been disrupted by AI in any meaningful way. But when I think about the long term and where artificial intelligence is going, I do think that there is a future risk of this business being disrupted. Adobe is a stock that I used to own in my portfolio back in around 2023, I believe. I bought my first shares when Adobe fell on the announcement of their Figma acquisition because I thought the stock got way too cheap. But over the past few years, just witnessing how quickly artificial intelligence has improved at content creation, it's caused me to not be comfortable buying back into Adobe. And it's not one that I'm really looking to add to my portfolio because, again, I wouldn't be comfortable with it in there. But moving on to the next stock that I think has a high risk of AI disruption, this one is Monday.com. Instead of using one app for your to-do list, another app for your sales tracker, and a third app for marketing plans, Monday.com gives you a blank board where you can build all of those things using simple, colorful blocks. It's famous for being highly visual and no code, meaning anyone can build a custom business tool without knowing how to program. However, new AI tools like Claude Code or Replit are allowing a regular manager to say, build me a custom project tracker that looks exactly like my team's workflows. And AI builds it for free or for very cheap within seconds. And I've created a quick list of pros and cons for a lot of these businesses. So the pros for Monday.com is that it did introduce Monday Vibe, which allows non-technical users to build entire custom applications just by describing them, which makes the platform much more powerful for small businesses. Monday is also launching its own AI agents, which have shown 150% quarter-over-quarter growth. The business is also continuing to grow its revenues by over 20% annually, which is pretty strong growth for any type of software company. So now let's move on to the cons. Because Monday.com is a horizontal tool, again, its general purpose, it is easier for AI to replicate. In 2026, a company could theoretically use a free AI agent to manage their tasks in a simple spreadsheet or a Slack channel, potentially making a $30 per user per month Monday.com subscription feel expensive. Simple task tracking, status updates, and workflow automation are all commodities by AI as well. And lastly, Monday.com charges per seat, which could be at risk if organizations become leaner. Now, this is an additional risk that investors are worried about, but we haven't fully discussed yet. And this is the per seat pricing that a lot of software companies like Monday.com have. So I'm sure that we have all seen the headlines that companies like Amazon and Meta are laying off thousands of people. And what this means for companies that charge per seat is that if there are less people working at these organizations, then they're ultimately not going to be making as much money. So that is an additional risk for a company like Monday.com. However, if we go and take a quick look at Monday, we can see that the stock is down roughly 60% from its recent highs just back at the beginning of 2025 once again. This business is now trading for roughly 20 times free cash flows. And if we go and take a look at their financials here, we can see that their revenue is continuing to grow very strong and hit fresh all-time highs. If we zoom in here, once again, we can see that they're continuing to compound their revenue by 29% since 2024, and the business is expecting to continue growing its revenues by 20% going forward. Now, if we take a look at cash flows have been continuing to grow, but not quite at the same rate as overall revenues. So the company's profit margins have been contracting slightly over the past few quarters, which we can see right here. They peaked at 33% in 2024, and in the most recent quarter, they're now sitting at 28.3%. But if Monday.com can continue to grow revenues by over 20% over the long term, and AI doesn't truly disrupt this business, then a 20 price to free cash flow is looking pretty dang cheap for the stock. But there is that risk that over the long term, this business could be disrupted by artificial intelligence. Now, the next business that I think has a high chance of being disrupted by AI is Salesforce. Salesforce helps salespeople track sales leads and customer interactions. They also help with customer service and marketing analytics tracking. This software can be used by almost any business, which makes it a horizontal software company. Now, the pros for Salesforce is that its Salesforce AI agents have become their fastest growing product in history. By early 2026, they have reached $540 million in ARR, which was a 333% increase from the prior year. Salesforce Data Cloud is also booming because AI needs clean, unified data. In the third quarter of 2026, Salesforce processed 3.2 trillion AI tokens and ingested 32 trillion data records, which was a 119% increase from the previous year. This does suggest that at least so far, Salesforce is successfully building AI agents and AI products that they are selling within to their current customer base. And it seems like they're seeing quite a bit of growth. However, the cons for Salesforce is that they do offer seat-based pricing that could be impacted once again if organizations become more lean. Salesforce is trying to pivot to consumption-based pricing models due to this, and charging $2 per conversation. Now, my thoughts on this consumption-based pricing that a lot of software companies seem like they want to do is that it's going to suck for the customer. Like, for me as an Adobe customer, let's go back to my Adobe example. If I wanted to start generating videos within Premiere Pro, but Adobe was starting to charge me 50 cents every single time that I used a prompt to try and create a video with artificial intelligence, then that would just kind of suck. It's nice to have that recurring subscription and price that you know is consistent because it helps you budget. But if every single business is going to start going to a usage-based model, then your costs are going to fluctuate. And it also means that your costs are going to scale with your overall business. Again, as a customer, it kind of sucks to see that software companies want to go this way. And who knows, maybe we live in a future world where everything is usage-based pricing and not a flat fee every month. But moving on to the next con for Salesforce business is that small, nimble, AI-first CRM startups like TextApp or Observe are emerging, and they offer 80% of what Salesforce Power does with 0% of the complexity, and they're also a fraction of the price. Salesforce growth has also been low and slowing down, and the entire business seems like it is seeing deceleration. If we head over to CRM, we can see that the stock is currently in about a 38% correction from its recent highs in 2024. And if we head over to its financials and take a look at the revenue, we can see that revenue has been clearly decelerating over the long term. And if we zoom in here, the compounded annual growth rate to the revenue has been decelerating all the way down to 8%. Now, if we go and take a look at cash flows, I believe that they have been compounding by slightly faster growth rates because the company has been expanding its overall margins. But even still, the operating cash flows have only been growing by roughly 9% per year. So it does seem like Salesforce business overall has seen a significant amount of deceleration. It is currently trading for a price to free cash flow of roughly 16.6, which is a free cash flow yield of roughly 6%. And personally, I do think that this is a pretty fair price to pay for Salesforce business if it can continue to grow its revenues by 9% annually over the long term. But this one is not a very exciting company, and I do think that the deceleration across the entire business does suggest that they are struggling in this new AI world. And again, I do think that the disruptability of this business is pretty high due to how horizontal it is. Now, the last business that has a high AI disruptability risk is Workday. In simple terms, Workday is the digital central office for a company. If you work at a large organization, Workday is most likely the website or app that you use for everything related to your job that isn't the actual work itself, like getting paid, requesting time off, and doing paperwork. Managers use it to track job applicants, organize teams, manage money, and spot trends like a large amount of people quitting from a specific office location. Now, the pros for Workday is that it is leveraging AI to improve efficiency for customers. For example, their recruiting agent from the 2025 Paradox acquisition has increased recruiter capacity by 54% by handling scheduling and initial screening autonomously. Additionally, 75% of the Fortune 500 companies uses Workday in their business. So let's move on to the cons. A major Workday research report from January 14th, 2026 found that 40% of AI time savings are currently being lost to rework, which is humans having to double check and fix low quality AI outputs. If this doesn't improve, then customers may stop paying a premium for the AI features. Workday also has seat-based pricing, which we already discussed, and AI startups are building clones that might be good enough for smaller businesses. So it does seem like Workday has a strong foothold within larger companies, with again 75% of the Fortune 500 using this business. But I don't think that smaller companies necessarily would need as complex or as in-depth of a service. Again, Workday is pretty horizontal, and it does seem like a lot of AI startups are trying to attack this business's moat. And the smaller companies that don't necessarily need as much from Workday may switch to a smaller competitor that does 80% of what Workday offers. It also seems like Workday may not be implementing artificial intelligence as good as customers want, because as they just said in their own report, customers are saving roughly 40% of their time, but they're having to spend that time to double check the AI because AIs hallucinate, and it seems like Workday may have made a low quality AI. If this trend does continue, then customers may lose faith and trust in Workday's AI. And again, they may want to stop paying for it because they're not really getting a net benefit from the AI, at least right now. All right, let's now move on to the group that I think has a moderate chance of being disrupted by artificial intelligence. And the first stock here is Atlassian with the ticker symbol TEAM. Companies use Atlassian to track the work being done by their own employees. Their business is built on two main pillars. The first one is Jira. This is a digital to-do list for teams. It allows managers to break big projects into small tasks, assign them to people, and track progress until they're done. Then they have Confluence, which is a shared digital filing cabinet or internal Wikipedia. It's where teams write down their plans, meeting notes, and instructions so that everyone has access to the same information all in one place. Now, the reason that I put Atlassian in the moderate and not at the high risk of AI disruption is because I think Atlassian goes a little bit deeper with companies' data. It is a horizontal software business, but I think that it is probably somewhere near the top, but slightly deeper than the other companies like Salesforce or Monday.com. But let's now get to the pros of Atlassian. And the first one is that as of January 2026, Atlassian's AI features reached 3.5 million monthly active users, which was a 50% increase in just one quarter. This also helped drive a 26% jump in the company's cloud revenue, reaching nearly $1 billion. The cons for the business are that investors are worried of new AI coding agents, like Anthropic's Claude Code, that can write, test, and deploy software. If an AI agent can manage the entire development lifecycle, then the need for a separate, expensive tracking tool like Jira could diminish. To stay competitive, Atlassian made the bold move in 2026 to include Rovo at no cost for most paid plans, which is one of their artificial intelligence features. While this keeps users in the ecosystem, it makes it harder for the company to monetize its AI research directly. As discussed earlier, basic workflow automation and documentation is also vulnerable to artificial intelligence disruption. Now, if we head over to Team really quickly, we can see that in February of 2025, it was roughly $323 per share. and the stock is now down roughly 60% from those highs. It's also trading for a price to free cash flow of 23.8 today. So let's go and take a look at how the business is growing now. And we can see that its revenues have been growing very consistently and are sitting at an all-time high. And if we zoom in here, we can see that the compounded annual growth rate to the revenue is still maintaining above 20% per year. If we take a look at cash flows, we can see that they have been compounding by roughly 20% per year. However, they have been flatlining since about the second quarter of 2024, which is about 18 months now. This ultimately means that Atlassian's free cash flow margins have been declining, and they've actually been declining for a few years now. We can see here that the free cash flow margin was roughly 39% in 2021, and now it's all the way down at 26.7%. But ultimately, the business is continuing to grow by roughly 20% per year and trade for a roughly 24 price to free cash flow, which I do think is looking pretty attractive if they can keep that growth rate up. Now, the next stock that I have rated as moderate for AI disruptability risk is Autodesk. In simple terms, Autodesk is the company that provides the digital blueprints for the physical world. If a human is building something, whether that is a skyscraper, a car, a movie character, or a bridge, they likely used Autodesk software to design and simulate it before it was ever made in real life. Autodesk is making AI-powered tools like smart blocks and auto layering, which was introduced in the 2026 version of their software, which makes individual designers significantly more productive, sometimes up to 10 times faster. However, if one architect can now do the work of 5, then a firm might only need 20 Autodesk licenses instead of needing 100 previously. Autodesk is desperately trying to shift to consumption-based pricing to make up for the potential loss in seats. Now, the pros for Autodesk is that it is implementing artificial intelligence within its own products and customer workflows. Customers upload data about parts and specific design requirements, and then Autodesk can generate hundreds of potential designs based on those requirements. They also leverage decades of industry knowledge, proprietary data, and building requirements into their designs. It is also seen as the industry standard with #1 market share in the United States. The cons for the business are that AI can generate designs, so competitors could try and create similar products. If Autodesk does improve the efficiency of its customers, like one designer can do 10 times the work, then less people will need to use the product, which does put a headwind on their seat-based pricing. And as we just read, they are trying to pivot to usage-based pricing due to this. Autodesk is an interesting stock to me because they have a very long track record of outperformance. This was a $6.22 stock back in 1991, and the stock is now up roughly 4,000%, even including its current dip. So it has produced 40x returns over the past about 30 years. Now, if we zoom in, we can see that Autodesk is currently in a roughly 17.5% correction, which is not nearly as big of a correction as the other businesses that we have talked about, but it is still seeing a correction with the overall software space. Its price to free cash flow is now sitting at 27.5, which is not necessarily cheap in my opinion. The company's revenue growth rates have also been very strong and compounding by roughly 17% per year, and it's actually seeing some slight revenue acceleration in the past few quarters. Cash flow has been a little bit more volatile though, and operating cash flows are not at an all-time high, which was back in 2023 at $2.4 billion. So the company's operating cash flow margin is seeing a little bit of compression. Now, the reason that I put Autodesk in the moderate category is because they are kind of like a generative AI company. They do use proprietary technology, and they are a vertical market software business, specifically in the design space, but they use their proprietary technology to generate designs now. And they are moving to that usage-based model where their customers will be charged based on how much they're using this AI generative capability. So they do have a data moat because they've been in this industry for decades and they know all of the requirements for buildings and designs to be made that they can leverage to make the designs more valuable to the customer. But getting into this generative space is the reason why I did lower them down from low to moderate AI disruption risk. Now, moving on to the next stock in the moderate category, this one is Nemetschek, which I have covered on my channel before and is very, very similar to Autodesk. In fact, these two companies are direct competitors and they are seen as the leaders within their industry. Nemetschek stock has also been a massive, massive outperformer. Back in 2007, this thing was worth 48 euros. And even in its recent correction, the stock is still up roughly 18,000%. If we also zoom in, we can see that Nemetschek's correction has been larger than Autodesk, and the stock is down 44% from its recent highs. This stock is also selling for a slightly lower price to free cash flow multiple at 23 times cash flows. Now, if we go and take a look at this business's fundamentals, we can see that its revenue has been compounding extremely well, as well, at around 17%. The revenue growth rates have also been accelerating as the business has been acquiring some artificial intelligence design companies. This is part of the company's strategy to make sure that they are staying on top of the latest artificial intelligence developments and being able to offer those AI developments to their customers. Nemetschek's operating cash flows have also been growing extremely well, and they're sitting at an all-time high of 395 million euros. They've also been compounding by about 21.4% annually. And in my opinion, Nemetschek's fundamentals look slightly better than Autodesk's, which is the reason why I covered Nemetschek on my channel instead of Autodesk about 2 months ago. This is a stock that has been on my radar and on my watch list for quite some time, because I do believe that it does have a defensible moat, although I am slightly worried about that generative AI and that moderate AI disruption risk on this business. But just like with Autodesk, if Nemetschek can continue to compound its fundamentals by 20% annually going forward, then I think that this is a very compelling price for the business. And in fact, this is one of the cheapest multiples that the stock has seen in around a decade. Now, the next stock that I placed in the moderate category is Intuit. And the reason that I placed Intuit in the moderate category is because they are like a tax filing and accounting service. They are a horizontal software company, but just like with Atlassian, I think that they sit slightly deeper in a company's overall data. Additionally, I think that there are additional moats with Intuit's business simply because of how critical it is to get your tax filings right. I posted recently on X specifically about Intuit stock because personally, I would not trust an AI to completely do my taxes with no review because AI does hallucinate and it does make mistakes. So it's not quite there yet where AI can do your taxes for you and completely disrupt Intuit's business. And Intuit is also leveraging AI and using its own proprietary data on how the tax system works to improve the efficiency of its overall software for its customers. And it's actually seeing some pretty good gains there. And the business is also projecting its revenue growth rates to accelerate to 20% by 2030 due to the AI leverage. So I do think that there is a chance that artificial intelligence could be a net benefit for Intuit's business, but when I think 5 to 10 years out into the future, I could see artificial intelligence making it easier and easier for your average person to file their taxes or for competitors to understand the tax code, use AI to learn the tax code, and create their own products as well. Additionally, the United States is working on a completely free tax system that its citizens can use to file their taxes, and this is directly competing with Intuit. It doesn't look that robust or that good yet. It doesn't compete with the level of accuracy and development that Intuit has right now, but this is something that the United States is working on. And if people are trying to save some money, then I could see them using this instead. Intuit is a global business, so that won't impact them in like Canada, for example. But overall, I do think that there are some risks with Intuit's business in regards to artificial intelligence. And that is why I put it in the moderate category and not in the low risk category. Now, if we take a quick look at Intuit, we can see that the stock peaked here in July of 2025 at $807 per share, and it is currently in a roughly 30% correction. And now the stock is trading for a price to free cash flow multiple of roughly 25. So let's quickly go and take a look at its revenue growth. And we can see that Intuit has been growing its revenues very consistently and actually seeing its revenue growth rates accelerate since about 2020 and even in the most recent quarters. And if I zoom in here, you can see that the compounded annual growth rate to the revenue has actually been increasing. However, if we zoom in past the 2020 era, then it has been growing by roughly 15% per year. And going forward over the next year, they are expecting about 13% revenue growth. If we take a look at Intuit's cash flows, we can also see that they have been growing quite consistently and they are hitting an all-time high, which is great to see. So it seems like Intuit is expecting a slight deceleration to the business over the next year or so, and then a re-acceleration heading into 2030. And overall, if the business can continue to grow by double-digit growth rates from here, then I think a 25 price to free cash flow is pretty fair for the business, but I don't think that it is necessarily super cheap or undervalued. All right, let's now move on to the stocks that I believe have a low risk of AI disruption. And the first one here is Snowflake. In simple terms, Snowflake is a giant smart library in the cloud where a company stores every single piece of data that it owns. Before Snowflake, companies kept data in silos. sales in one place, website clicks in another, and HR records in a third. Snowflake's business is to provide one single massive data cloud where all that information lives together so it can be analyzed instantly. Now, the pros for Snowflake's business is that AI tools require more data and increase the overall usage of Snowflake's products. By January of 2026, Snowflake surpassed $100 million in revenue run rate solely from its new AI products, reaching this goal more than a full quarter before it was expected. Snowflake's data infrastructure becomes more valuable with AI, not less. AI needs massive, clean data, and that is Snowflake's wheelhouse. The cons for Snowflake is that Google, Amazon, and Microsoft are all building AI tools directly into their clouds as well. Snowflake must convince its customers that its platforms are worth the premium price over the good enough tools that already are included in their own cloud bills. If we go and take a look at Snowflake, we can see that its stock actually peaked here in 2021 at $402 per share. It is still down roughly 47% from that high, but this is simply because, in my opinion, Snowflake stock was massively, massively overvalued. If we zoom in, relative to its recent high that it set in here in November of 2025, the stock is down roughly 24% today and is in a correction. However, Snowflake is still trading for a price to free cash flow of 93 and a price to sales ratio of 16, which are very high multiples still. If we go and take a look at their financials, we can see that their revenue is scaling incredibly well and hitting an all-time high of 4.4 billion in the trailing 12 months now. If we zoom in, we can see that the business has consistently compounded its revenue by roughly 30% per year, which are great growth rates, and one of the fastest growing businesses in this entire group. Snowflake's cash flow has been a little bit of a different story though, and cash flows have been stagnant since about 2024, so its operating cash flow margins have been compressed. And one of the main issues with Snowflake is that its stock-based compensation is double the operating cash flow. So shareholders are being diluted by quite a bit, and insiders are making billions of dollars and much more than the overall operating profits of the business. So overall, I think the risks to Snowflake's business from artificial intelligence are pretty low, and I think that it is right on the precipice of actually benefiting from AI. So we're going to have to see how this one plays out over the long term. Now, the next stock that I put on the low list is ServiceNow. ServiceNow automates IT tasks, manages employee HR requests, streamlines customer supports, tracks assets, manages security incidents, and provides a unified portal for employees to access services, all built on a single platform for workflow automation and digital transformation. It monitors a company's servers and cloud infrastructure to protect it when something breaks. If it detects a server is about to crash, it can automatically create an incident and alert the engineering team before the website goes down. Now, here's some of the pros for ServiceNow. ServiceNow has launched Now Assist, an agentic AI across its entire platform. These aren't just chatbots. They are autonomous agents that can diagnose a server issue, initiate a fix, and notify users without human help. And in my opinion, monitoring AI agents, I think, will become a big and important business, especially as more companies use AI agents. Additionally, enterprise service management becomes more complex with artificial intelligence, not simpler. And ServiceNow is an AI platform for business transformation. They have 85% of the Fortune 500 as customers, and the average revenue per user for the business is continuing to trend up, which does suggest that they are adding more value to their customers, and customers are willing to pay a higher price every year. Now, the con that I found for ServiceNow is that it has seat-based pricing, which means that it could be impacted by leaner organizations if there are less employees that need to use their services. And here we can see that ServiceNow peaked in January of 2025 at $234 per share, and the stock is now down roughly 45% from those all-time highs. It is still trading for a price to free cash flow of 35.4, which is on the higher end in my opinion. But if we go over to its financials and take a look at the revenue growth, we can see that its long-term revenue has been incredible. This is like one of the most beautiful revenue growth charts I've ever seen. Not quite as good as Mercado Libre, but still very, very good. But if we zoom in, we can see that the business is still compounding its revenue by over 20% per year, which is great to see. If we go and take a look at the operating cash flows, we can also see that they have been continuing to compound and scale for over a decade now. And if we zoom in here, we can see that they are currently compounding by about 23% per year. And again, it's also good to see that the revenue is continuing to compound by over 20%. However, I do think that ServiceNow is looking on the more expensive end, trading for that price to free cash flow of 35.4. And I think that there are better deals in the overall software space. Let's now move on to the next business, which is Roper, and is actually a competitor of Constellation Software. And I have both of these in the low risk for AI disruption. Roper and Constellation Software are both vertical software businesses that are deeply embedded within their customer operations. They are very sticky and hard to replace. And I'll continue this conversation in the context of Constellation Software because I know much more about this business. So Constellation Software owns over 1,000 vertical market software businesses, and it is known as one of the best serial acquirers of all time. The pros for Constellation Software are that Constellation is using AI to modernize its own portfolio. One of its operating groups is already using AI to handle over 50% of customer service inquiries, and many are using AI to refactor old legacy codebases into modern cloud versions that are faster and cheaper than before. Most of Constellation Software is mission critical. A water utility company isn't going to replace its 20-year-old billing system with an AI chatbot that might hallucinate or make a mistake. The cost of failure is simply too high, giving Constellation a massive trust moat. AI fears have also made small software companies cheaper to buy. Constellation thrives on buying companies at low prices, usually around 1 to 2 times revenue, and the AI scare is providing them with more bargains and more opportunities to deploy capital, which is the main way that the business grows. They own hundreds of tiny monopolies in niche markets, like library software or water billing, where customers are too risk adverse to switch to unproven AI startups. AI just makes their internal operations more profitable and more efficient. Constellation's customers value reliability over everything, since their businesses literally run on the software, and they cannot even operate without it. Additionally, Constellation software costs is less than 1% of their customers' revenue. This is at the same time as the risk of changing softwares is high. And in some cases, again, operations would need to completely stop because they cannot operate without the software. And just think about this. Constellation software cost is less than 1% for their customers, which means that even if they could save 50% on using a different software other than Constellation's, they would still only expand their overall margin by about 0.5%. This is at the same time as their business relies on the software to operate. So there is a massive risk with not that much reward of trying to swap out Constellation's software. And this is partly why I think the software is so sticky and not really at a high risk of being swapped out from some AI vibe coded software. But moving on, the markets that Constellation operates in are usually niche and too small, roughly $5 to $10 million in a total addressable market, to attract VC money, disruption, or competition. To put it simply, the rewards of even displacing Constellation software in one of its markets isn't that high. So venture capital and other software companies aren't even really trying to displace them because, again, the reward is just not that high to even try. Constellation also reported that its customers are going to Constellation to build and integrate AI tools into their systems. So personally, I think customers want to stick with what works and what has been working versus investing in something sexier but potentially less reliable. Now, the cons for Constellation software is that AI is lowering the barrier for entry for creating software and speeding up software development times. This ultimately means that there could be more competition in the future that could suppress Constellation's profit margins if competitors are successfully attacking their moat and stealing customers with lower prices. But moving on, investors currently believe that AI is going to replace many of Constellation Software's businesses. I don't necessarily believe this, but that is what the market is currently thinking and partly why Constellation has sold off so much. Some customers in non-critical niches may want to build their own in-house modern software as well by vibe coding some AI software if Constellation's software that they're selling to the customer is not mission critical. So these are the main bear cases that I have found online. But personally, based on everything that I have seen, I think the true risk to Constellation Software's business is pretty low from artificial intelligence. So let's quickly go and take a look at Constellation Software, and you can see my buying patterns on the stock right there. But the stock peaked here at about $5,200 per share in May of 2025, and it is now down 48%, and it's pretty much in a straight up crash. The business is now trading for 16 times free cash flow, which is the lowest multiple that it has traded for since 2015, which is 11 years ago now. And if we take a look at Constellation's revenues, we can see that they are continuing to hit an all-time high and scale, and they are in fact continuing to compound by roughly 20% per year, which is very good to see. If we take a look at operating cash flows, we can also see that they are continuing to compound and hit fresh all-time highs. And the operating cash flows are actually growing faster than the overall revenue, sitting at about a 27% compounded annual growth rate since 2023. So Constellation's profits are continuing to explode. I personally think that Constellation Software is one of the highest quality businesses in the entire market with some of the best management that I have ever seen. So for a 16 price to free cash flow for 20% annual growth, I think this business is offering a very compelling price, especially when I believe that the true AI disruption risk to this business is quite low. All right, let's now move on to the stocks that I think actually benefit from artificial intelligence. And the first one is Palo Alto. Palo Alto is a cybersecurity company. And to put it simply, I think that cybersecurity is only going to become more important as artificial intelligence continues to develop and our world continues moving more and more online. I also think that AI is going to create a whole new wave of cybersecurity incidents and things that we need to defend against. And therefore, the companies protecting us from those new AI threats, I think, are only going to see more demand and become more important for companies. So let's go and take a quick look at Palo Alto. And we can see that the stock has been a massive winner since it IPO'd in 2012, and it is now up roughly 18x since its IPO. Now, if we zoom in here, we can see that the stock is in a little bit of a correction right now, and it's down roughly 18%. So it hasn't been hit nearly as hard as some of the other companies on our list, but it is still in a little bit of a correction. Despite this little correction, the business is still trading for 34 times cash flows today though. So let's go and take a quick look at its financials now, and we can see that the business is growing very consistently, and its revenue is at an all-time high of roughly $9.6 billion. Now, if we zoom in here, we can see that the compounded annual growth rate to the revenue does decelerate as we zoom in and as the business scales, and it's currently growing by roughly 15% per year. And that is also what the business is projecting going forward. If we take a look at the company's operating cash flows, we can see that they are a little bit more cyclical and not growing as consistently as the revenue, but the operating cash flows are at an all-time high of $4 billion now. But in my opinion, I do think that a 34 price to free cash flow for roughly 15% annual growth is a pretty high multiple to pay. So I do not think that Palo Alto is necessarily offering a discount today, and it is still on the expensive end, at least in my opinion. Now, moving on to the next stock that actually benefits from artificial intelligence, this one is CrowdStrike. CrowdStrike is also a cybersecurity company and benefits from AI for all of the same reasons that Palo Alto does. CrowdStrike stock has been quite volatile since it IPO'd in 2019. We can see that it initially ran about 400% to 2021, then it saw a roughly 66% correction in 2022, and since 2022, it is now back up another 350%. Now, if we zoom in here, we can see that CrowdStrike is in a little bit of a correction, roughly 20%, just like Palo Alto, but it is not in nearly as much of a correction as the other software stocks. CrowdStrike is also trading for a price to free cash flow of 103 today and 25 times sales. In my opinion, this is the most expensive stock on our entire list. So let's go and take a look at its fundamentals now. And we can see that CrowdStrike's revenue is growing and scaling well, and its revenue is at an all-time high of $4.6 billion. So let's zoom in a little bit and see what the current compounded annual growth rate to the revenue is, and it's sitting at roughly 22%. So CrowdStrike is still growing its business by over 20%, which is good to see for its fundamentals. Now, if we take a look at CrowdStrike's cash flows, we can see that they've actually been flat for the past about 5 quarters now. It did see a little bit of a jump recently, but its operating cash flows are now sitting at roughly $1.5 billion. But overall, I think that a 103 price to free cash flow and 25 times sales is a very, very high price to pay for any business, and especially one that is only growing its revenues by about 22% annually now. So in my opinion, I do think that CrowdStrike stock is actually looking overvalued today. Now, moving on to the next stock that actually benefits from artificial intelligence, this one is Dynatrace with the ticker symbol DT. Dynatrace provides an observability and security platform for giant corporations. It monitors their clouds, applications, and infrastructure to ensure they don't go offline. Their core engine, unlike generative AI, which usually guesses, Davis is a casual AI. It looks at the cause and effect of a system failure to tell an engineer exactly which line of code just broke. It monitors everything from the health of a server to whether a hacker is currently exploiting a vulnerability in a live application. Now, the pros for Dynatrace are that as companies deploy hundreds of AI agents, their systems become more unpredictable. Dynatrace's revenue grew 18% in late 2025 because companies need their agentic AI observability to keep these new systems from spiraling out of control. Cybersecurity, as I said, is going to become more of an issue over time, which could increase the demand for observability of your systems. Now, the cons for Dynatrace are that companies like Datadog and Snowflake are moving into Dynatrace's territory. New AI native startups are also building simpler, cheaper monitoring tools. If these tools are good enough and can handle 80% of what Dynatrace is doing using generic LLMs, then Dynatrace may lose its grip on the mid-market or with smaller companies. But in terms of large corporations, I do think that Dynatrace has a pretty clear benefit from AI agents needing to be monitored. So let's go take a quick look at Dynatrace's stock here. And if we zoom in, we can see that its recent high was in February of 2025, and the stock is down roughly 34% since then. So it is in a pretty meaningful correction. The stock is also trading for a price to free cash flow of 26 now. So it's not the cheapest stock in our list, but it's also not the most expensive at all. So let's go take a quick look at some of its fundamentals. And here we can see that its revenue is also continuing to scale and hit all-time highs of roughly 1.9 billion in the trailing 12 months. And if we zoom in here, we can see that the business has been consistently growing its revenues by about 20% per year, which is pretty dang strong. If we head over to Dynatrace's operating cash flows, we can also see that they have been compounding by roughly 20% per year, and it seems like they still are. So Dynatrace seems like it is continuing to scale its business by roughly 20% per year, and if it can continue to grow at this rate going forward, then I do think that a price to free cash flow of roughly 26 is pretty fair for this business. And again, this is one of the businesses where I actually think that it will see increased demand from artificial intelligence and specifically AI agents needing to be monitored. Now, the last business in our table that actually benefits from artificial intelligence is Datadog. In simple terms, Datadog is the health monitor for a company's entire technology system. Datadog allows customers to build custom dashboards that monitor their data and businesses. If something within the system starts failing, then Datadog reports it and lets the user know. Datadog is also working on AI agents that will self-heal the system when it identifies that it is starting to break. Currently, AI systems are much more complex and demanding than regular software. This means that there's more data and compute flowing through Datadog, which is increasing its usage-based billing. As a result, AI is actually directly benefiting Datadog's usage-based revenues and is acting as a tailwind for the business. Now, the pros of Datadog are that monitoring an AI app is far more complex than a normal app. This creates a mountain of new data that Datadog charges to store and analyze. Revenue from AI native customers like OpenAI doubled in late 2025 and are now making up 12% of the company's total revenue. However, the cons for the business are that in 2026, competitors like Snowflake and Palo Alto are attacking Datadog's high margins. They argue that in an AI world, storing data should be much cheaper than what Datadog currently charges. New AI native open source tools like Signos or Dash Zero are gaining ground and promising zero vendor lock-in, making it easier for startups to avoid Datadog's premium price tags. So to put it simply, artificial intelligence is also allowing competitors to make similar products for cheaper. But I do think that in the meantime, Datadog's business is going to be a net benefactor from artificial intelligence. But first, let's go and take a quick look at Datadog's stock price. And here we can see that it actually recently peaked in November of 2025 at around $200 per share. And it is currently in a roughly 35% correction. However, Datadog is still trading for a price to free cash flow of 53, and its price to sales ratio is 14.2, which does make it one of the more expensive stocks on our entire list. Now, if we go and take a look at Datadog's financials, we can see that they have been scaling their revenue very strongly, and it looks like their revenue growth rates are actually accelerating in the past few quarters. And if we zoom in here, we can see that they are continuing to compound their revenues by roughly 27% per year. Datadog's cash flows have also been scaling very well, and its operating cash flows have compounded by roughly 37% per year since 2023. So this business seems like it is continuing to scale and grow in an artificial intelligence world. However, I do think that the price tag of 53 times free cash flow is still pretty expensive for this business, even if it is growing by 26% per year. So I don't think that this one is necessarily undervalued or offering value in the market today, even though its stock is in that 30% correction. Now, as I said, I did make some charts based on all of the data from the companies in the table. And the first chart that I want to show you is a price to growth chart. I know that a lot of people watch my channel and think that I am a value investor, but I personally think that value and growth is the same thing. Investing is investing, and growth does impact the valuation of a stock. So the chart that I made on the y-axis is the company's price multiple in terms of price to free cash flow. Then the x-axis is the company's projected revenue growth rates. So basically the way that you can think about this chart is the further right and lower down the stock is, the cheaper the stock is. And the further up and further left the stock is, the more expensive it is, because it would be trading for a higher multiple and seeing less growth. So the growth doesn't necessarily justify that multiple. And based on this chart, we can see that the cheapest stocks would therefore be these ones right here, which are Monday.com, Duolingo, Topicus, Team, and Constellation Software. Now, the most expensive stocks on this list would be Palo Alto and ServiceNow. I didn't put in Snowflake and CrowdStrike because they literally break the entire chart because they're trading for, 100 times free cash flows. But based on the stocks that actually fit in the chart, Palo Alto and ServiceNow are looking the most expensive, even relative to their projected growth rates. The companies that are looking more fairly valued relative to their projected growth rates would be this group right here. These are all of the companies like Autodesk, Nemetschek, Dynatrace, Intuit, Workday, Salesforce, Wix, Adobe, DocuSign, and Roper Technologies. However, I do think that this group of businesses right here, Salesforce, Wix, Adobe, and DocuSign, are looking quite cheap because these were the businesses that do have some pretty high AI disruptability risk. And that also kind of applies to Monday.com and Duolingo. These two businesses right here, I would actually say look the cheapest out of all of the businesses. But Monday.com and Duolingo, I do think do have some AI disruptability risk. Ultimately, the businesses that I think look the most attractive are Constellation Software and Topicus, because these two businesses have demonstrated very high growth rates. I think that they're very shareholder friendly, and I also think that their AI disruptability risk is quite low. So these are the stocks that I have within my own portfolio. Now, moving on to the next chart, this one is stock-based compensation as a percentage of the company's free cash flow. And we can see that Snowflake breaks the chart. It's literally at something like 200 times free cash flow. So again, I just capped it at 100%. So Snowflake is doing a lot of stock-based compensation. CrowdStrike, Team, and Datadog are also doing extremely high stock-based compensation at over 80% of their free cash flow. Then we have Workday, DocuSign, and Dynatrace doing roughly 60%. And the one that really stands out here to me is DocuSign, because this business, I think, has a very high chance of being disrupted by artificial intelligence. It's also not growing that quickly. So seeing 60% stock-based compensation, I think, is just unjustified and extremely high. And Wix is another one where I don't really understand, because it's doing almost 50% stock-based compensation, while its business seems like it's being completely disrupted by AI, and it's not really growing that quickly at all. Then we have Duolingo, Palo Alto, and Intuit all doing over 25% of free cash flow as stock-based compensation, which I do still think is pretty high. Then we have Salesforce, Autodesk, and Adobe doing roughly 20 to 25% of their free cash flow as stock-based compensation, which I do still think is pretty high, considering that all of these businesses are not growing by very high growth rates, and especially Adobe and Salesforce are not seeing that high growth rates at all. Then lastly, we have Roper Technologies doing roughly 8% of their free cash flow as stock-based compensation, which is pretty low, and Constellation Software and Topicus doing absolutely no stock-based compensation. And I love to see this. These businesses, in my opinion, are the most shareholder-friendly by far, which is also part of the reason why these two are the ones within my own portfolio. Now, the last chart that I made is a stock-based compensation percentage of free cash flow divided by the company's revenue growth rates. This basically tells us how much stock-based compensation the company is doing relative to the amount of revenue growth the business is seeing. Because I do think that there is an argument that if the business is seeing very strong performance, then there could be a higher level of stock-based compensation that is justified. And this chart is meant to show us how justified the company's stock-based compensation could actually be. And in this chart, we have DocuSign as number one. And this is because, as we saw, the company is doing a large amount of stock-based compensation, but the business isn't really growing all that much. So when you do the stock-based compensation relative to growth, then DocuSign is actually the worst company here. Snowflake is also still doing a lot of stock-based compensation relative to its revenue growth. Then we have Team, Wix, Workday, CrowdStrike, Dynatrace, and Datadog all still doing some pretty high stock-based compensation, even though these businesses are growing quickly, except for Wix. Then we have ServiceNow, Palo Alto, Monday.com, Intuit, and Salesforce all doing a moderate amount of stock-based compensation relative to those companies' growth rates. Then lastly, we have Adobe, Autodesk, and Duolingo actually doing some pretty low stock-based compensation relative to the growth rate that the businesses are seeing. And then lastly, we have Constellation Software and Topicus once again doing absolutely no stock-based compensation. So based on these charts and just in my own opinion, I think that all of these businesses right here are doing an excessive amount of stock-based compensation. And then starting from ServiceNow, I think that these businesses are doing more realistic levels of stock-based compensation relative to the amount of performance that the businesses are seeing. So ultimately, I think that the most attractive business out of this entire group is Constellation Software. I think that it has a low AI disruptability risk. The business is also one of the fastest growing in this entire group. It's trading for one of the lowest price multiples. And I think that it is the most shareholder friendly by far by doing no dilution and stock-based compensation. Some other businesses that I think are looking interesting at their current prices would be Roper Technology, ServiceNow, Autodesk, Nemetschek, Intuit, Monday.com, and Duolingo. Duolingo and Monday.com I think are looking interesting simply because they are growing pretty quickly relative to the multiples that they are trading for. I do think that these businesses do have some increased AI disruptability risk, but I do again think that their prices are looking quite attractive today if they can continue to grow. Autodesk, Nemetschek, and Intuit I think are still very high quality companies that are not as at risk of AI disruption and are trading for some pretty fair prices today. Then we have ServiceNow, which is growing extremely quickly and I think has low AI disruptability potential, but it is on the higher end of that price multiple range. But still, I think it is a very interesting business and one to add to your watch list. But with all that being said, that is going to wrap up my video on the software industry. This one is probably going to be an extremely long video because I did a ton of research and covered a lot of stocks in it. If you did enjoy this video, then please remember to leave a like on it. And if you're new here, then please consider subscribing to my channel. And if you do want to support my channel further, then consider checking out my Patreon and you will get a lot of additional benefits, like getting access to my Discord community, my personal portfolio, and a lot of exclusive content from me. But with all that being said, thank you so much for tuning in. And if you made it to the end of the video, then thank you so much. I truly do appreciate it. And I hope to see you all again in my next one.